All right. Okay. So starting off, let me see if we can get this off. Okay. Oops. So today's agenda. So this is going to be about rates and pricing and, rising rate environment, all that good stuff. But we're also going to talk a little bit about, what lenders do up front with the buyer on the initial conversation. Part of our relationship sales is what I kind of like to call it, and how that all works. We're also going to talk about rates and pricing, how they work and why really no two loans are the same. So kind of, it's one of those where everyone's like, what are the rates and everything? And so try to give a general basis of what the rates are based on the current market. But every buyer's scenario is a little bit different. So we'll get into that. And then basically the two differences between a true buy down using discount points. And so I've got some copies of some rate sheets. Not sure if y'all have ever seen those, but we'll get into that and how really a true buy down works based off the risk of the loan. And then we'll finish up with everybody's 3, 2, 1. I know you guys have been sick and tired of hearing about that, but again, it's another tool in the tool shed regarding combating the rising rate environment and everything. And so, but the good news too is that rates are pretty much have peaked. So we're kind of at that lull, if you will, as we continue through the year to kind of bring them back down. So, all right. And then we'll do Q&A at the end. So any questions so far? And again, ask anything as we go. So, all right. Okay. So what happens in the lender's initial conversation with the buyer? So these are not necessarily in the order that I would go, but we want to get an understanding of the current financial position of the buyers. Are they, and we'll kind of get into each one a little bit here in a minute, but we want to educate the buyer on the loan process, setting clear expectations, no surprises. We don't like surprises at the end, of course, and which could totally kill a deal. And then starting to build a relationship. So I normally start building a relationship right off the first initial call with the buyer. I used to joke you can find out a lot about a buyer based on their area code. Just for an example, I had a guy yesterday, a buyer wants to do a lot loan, and he had a New York number area code. So I asked him, are you in New York? And he's like, no, I'm here in Dallas. He's like, but I used to live in New York and I haven't changed my area code. I was like, oh, and so the conversation kind of progressed, and it was more like he's from Trinidad. He got to the States in 2006. He was in the Army. So it's one of those things where you find something little and just start building that relationship, that trust right at the beginning. That helps along the way in regards to, segueing into understanding their position and setting expectations and educating them down the line. So getting a clear financial picture of the buyer's current situation. So as lenders, we really want to get the overall big picture of what a buyer wants to do. And so are they upsizing, downsizing? Do they rent? Do they own? How long do they plan on being in the home they're buying? Their income, are they just standard W-2s? They own businesses, self-employed, rental, fixed income? Are they retired? Do they live off pensions and Social Security? So we ask all those questions to make sure, kind of get an idea as to what we're dealing with. I should say dealing with, but what we're working with. And so, as we all know, some income is more complex than others. And so someone who's just W-2, cut and dry, but compared to someone who's self-employed, owns a couple businesses, maybe owns some rentals in other states, and it's more complex. And so we kind of have to get into the nitty-gritty of that. I try to make it not an interrogation. I kind of kid with them a little bit, but we do need to understand this up front. Again, it's kind of one of those things where we don't like surprises at the end. So if we can go ugly early, it's kind of what I call it, where you get all this information up front, it helps the processing of the whole loan as well. So, and then of course, what is their monthly payment goal? I I try not to talk too much about rate, really. I mean, a lot of buyers, you know, everyone's rates. And so I understand that. We can always, for the most part, hit a rate, but it may cost something, you know? And so really trying to get the overall objective of their goals and their plans, and what payment they're comfortable with is really what I focus on. You know, I've had buyers in the past where they have to have a certain rate because their uncle down the street got the same rate 4 months ago. And I'm like, yeah, but I mean, it's going to cost you a little bit more now. And so is it really worth it? And we'll kind of get to that in a second. And buying down the rate, is it worth to spend that extra money to save X amount of dollars a month in your principal and interest? And so a lot of times your break evens could be years out. And so most buyers, we're going to refinance within 5 to 7 years, or they're going to sell the home. So that's just kind of a rule of thumb. And then, of course, we ask for, you know, down payment, you know, we ask assets, and then, you know, their long-term plan. You know, do they want to stay in the home for quite a long time? Just a retiree home? Are they going to flip it? Are they going to stay in it for a couple of years and then rent it out? So all those, these are all the questions that we, for the most part, ask up front. So any questions on that? Okay, cool. So educating the buyer about the process, again, no surprises. So they understand the process, and it has an overall smoother, well, it's just smoother for the process overall. So what we talk about, you know, is the documents that are going to be required initially and throughout the process. I tell buyers, hey, listen, I need X amount. I need these docs up front, and it's going to go into underwriting. And then once it comes out underwriting, they're going to have more, you know, conditions that we'll need. And so I try to set those expectations with them. And so it's not a surprise to them that, oh, you know, I need to update my bank statement. I'm going to request updated bank statements, you know, later down the road because they're still looking for a property. And so things like that. We educate the buyers on their loan programs that's best suited for their situation based on their wants and needs. So again, it comes down to, you know, they're looking for an ARM, they want to buy down the rate, things like that. And so, of course, right now it's a big hot topic is the market trends and what are rates doing and current updates and things like that. So the more we can educate the buyer, the better the process. And also to, you build trust that way with the buyer, just like y'all do when you're out there showing them homes. You know, if you can pinpoint things that are wrong with a certain home and things like that, that definitely builds trust when you're trying to, like, so you're not just trying to get a sale is really what it comes down to. You're kind of spending time with the buyer, making sure that they fully understand things. That builds a lot of trust. And so the critical do's and don'ts, of course, up front, my line is always like, don't buy a Ferrari while you're looking for a home. Kind of funny, but not really. But you'll see that people will do that. They're not buy Ferraris, but they'll buy cars and everything else. And so I've had buyers where they're like, right when they're doing the application, they're gone in, they've traded in their old car for a new car. And I've had people just be like, and I can't pull the credit yet because it's not showing up on their credit report. And I'm like, well, how much more is your new car? That's $100,000 or $100 a month more. I'm like, okay, so the ratios are fine. And then it's like, I finally get the statement of how much it is, like $400 more. So, you know, it's just one of those things. So don't open new credit unless we recommend that. If you need credit repair, things like that. Limit large asset transfers. So when we're looking at assets, we have to source everything. And so for the most part, we're going to go back 2 months on bank statements. So if you're making large transfers and deposits and things like that, you know, mattress money as we used to call it, we got to find out where it came from. So, you know, if you sell your car, you made 10 grand off of it, we need a bill of sale, and, you know, in the check, and where's deposited. So, and then last thing is credit guidance or credit repair if necessary. So we've got some buyers in the pipeline right now that are not going to buy till May, maybe summertime. So their credit's not that great. So we can run credit simulators, which will basically kind of give an idea, okay, these are some collections, here's some disputes, or hey, you need to pay this balance down a little bit. And we can read credit simulators where basically it shows where we can take a 600 to a 680. So it's a really great tool that we have. Okay, I'm just rambling. Everybody good? Everybody's cool? Okay.
Hey, John. Hey, John, just a quick question.
Yeah.
On credit, what is kind of the bar for credit when you're going into a new home purchase?
Yeah. So rule of thumb. So conforming loans, your conventional standard, the credit score can't be below 620. FHA normally is 580. Jumbo, for the most part, based on the lender, it's anything over 700. Most of the time it's 720, could even be 740 for a jumbo loan. The VA is kind of a gray area. You can go, down to 580. I've seen, at times they go down to 680, 560, sorry, but I wouldn't recommend that. Of course, all those would be horrible pricing, but from a regulation standpoint or, lender standpoint, 580 for FHA, 620 for conventional, and then 700 plus for jumbo. So.
Thank you.
Absolutely. And so kind of getting back to setting expectations with the buyer. So I let them know that, even though the loan's going to go through several hands, I'm going to take it first. I'm going to send it to my loan manager. They're going to end up structuring it right before underwriting. Underwriting is going to take it. It's going to come out. It's going to be conditionally approved. So meaning that you are approved based on conditions that we are requiring. So, but also too, that I'm going to be with them from start to finish, cradle to grave, and everything. And so I will be their main point of contact, but it will go through, they will have a loan manager that will be working the loan as well. And so our loan managers that connected are super robust. They run credit, they run income calculations. They're basically a loan officer that's not licensed. I've worked with a lot of lenders and a lot of processing. There's just order taking and number punching and whatever. This is not like that here at Connected. So, and then also to how the process will flow, kind of we talked about before. So milestones, again, this kind of comes back to educating the buyer, giving them an overall view of how things are going to work. So structuring the loan, submitting in the processing, submitting in underwriting, and then closing and things like that. So, open communication is required from all parties in order to close on time. Everyone is working toward a common goal, and we're here to make the deal work. So, I've worked with lenders where like underwriting is the police of the loan. So we can't do it, we can't do it. So you have some lenders that you almost seem like the underwriters are like, they're trying to not make the loan work. And then you have some lenders that are, will bend over backwards and trying to make it work. So I keep pitching this, but Connected is a direct servicer, and we're also a direct lender, and we're also a servicer. So we keep some loans, we service them, and then others we bundle up, we sell them to the secondary market, to Wall Street. So it gives us we're agile in that area, so we can approve loans like 98% of the time. So it's really great. And then also the buyer must deliver documents in a timely manner. So this is really, really important, because what buyers think they may make, or basically that's what kind of what the gist of it is, especially with income, to have that, we want to make sure that we're not giving you guys a buyer. We want to make sure that y'all have a feasible buyer. Let's put it that way. So I request documentation up front quickly. So again, it comes back to that pre-approval compared to a pre-qualification. Pre-qualifications are basically worthless because it's just the buyer stating the income and assets. A pre-approval is where you're validating the income and the assets. So you want to make sure that you're taking a buyer out to see homes that have been pre-approved. Excuse me. Questions? Good. Okay. Okay, so how rates and pricing work. And so this is kind of the nitty gritty. Not to bore y'all. So rates are based off of pricing, and pricing is based off the risk of the loan, which is based off the buyer's specific situation. Less risk means the buyer will get better pricing. More risk, of course, means the buyer's pricing will not be as favorable. So kind of, you have to look at it from an investor standpoint. And so, hey, I'm going to lend this person $600,000. They got really shitty credit, job history, things like that. They're not putting down a down payment. There's a lot more risk to an investor, that type of scenario, compared to somebody that's got A+ credit, they're putting 20% down, and they've got great job history and ratios are low and everything else. So kind of look at it in that mind frame, if you will. So a lot of this was in the deck in the other CE training that I did last month. Excuse me. So these are the 4 pieces of a mortgage puzzle. Got to have this in order to do a loan, pretty much. Income, you got to have a job. If you don't have a job, you got to be, fixed income, pension, Social Security, things like that. If you have debt, you got to have debt, but you don't have to have debt. So, but you have to have credit and you have to have assets. And so this all makes the loan work. And so, okay. And so this is basically the same slide before, but let's look at the difference between 2 different buyers. So this is a rate sheet. Excuse me. And so back in the day, we used to have these in paper, and you take it with rulers and stuff. And so it's like a matrix in some ways. And so a lot of this. So let me kind of show you. So the scenario over here is a buyer that's got a 780 credit score and a down payment of 20%. And so the lock period for both of these would be a 30-day lock. So this is not any buyers. This is just a total example. And so, and not recent. So let's put it that way too. So this buyer over here has got a 680 credit score and a down payment of 5%. And so what we're looking at here is the rate. So if the buyer over here is in A paper, if you will, so they've got a rate of 6.5. This right here, the 0.883, is the discount point cost for this rate. And so this credit, or this buyer over here that doesn't have as good of credit, is putting less down payment down. Their discount point is 1.658. So it's costing this buyer that's over here more for the rate than it is this buyer who has got better credit and is putting more down. I don't necessarily look at, you're going to look at this rebate here. That's the monetary value of the cost. But what I'm looking at is the discount, really. And so it's going to cost, they have the same loan, they have the same, I can't see the sales price up there. So you have the same sales price. Now with a down payment of 5%, the loan amount is going to be more, right? And so if you have down payment of 20%, the loan amount is going to be less. So, anyways, and also behind all this pricing here is that you've got what's called LLPAs, and I'm not going to get into it, but the loan level pricing adjustments. And so those are pricing adjustments that's embedded, that's behind the scenes, if you will, of the pricing that's based off of credit, loan to value, debt to income ratio. So, all this. So when I always say, hey, pricing, this is the pricing. All this stuff over here, all this, the discount and the pricing. So, and so right now, for an example, when I send out those rates, like the arms right now, the pricing on the arms are like basically like a 30-year right now. The pricing is not good on the arms. And so, so that's how pricing works. And again, it's just, it's based off the risk of the loan. Does that make sense? I'm trying to think if I did that clearly. Anyhow, I'm trying to think. Any questions? I mean, and so also too, just to note real quick. So when you put down payment of 20%, that gets rid of your mortgage insurance, right? And so, which is great, but and so mortgage insurance to a lender is basically, think of it as being insurance for a lender. So lenders will look at it like this. So, okay, the buyer is only putting down 5% over here. This loan is riskier. And so they're gonna have mortgage insurance. And mortgage insurance is basically based off your credit. So, and we use 5 or 6 different mortgage insurance companies, and we find out which one will offer the least amount for mortgage insurance, because that helps with the ratios. And so, but for a lender, all of a sudden now they're doing 20% down. It's less for the lender. So that gets the mortgage insurance taken off. Okay. Any questions on that? So I guess the bottom line is just when the riskier loan, worse pricing, less risk, better pricing. So, okay, and so some of y'all may have seen this already as well. So this is how rates and points work. So when a rate has no cost, so we'll look at this for the most part, it's considered at par. There's and so, a par rate, someone says, hey, what's the par rate? That means there's no discount points, there's no cost for that rate. So down here, example, I locked in at 4% with no points. It was at par rate. So the closest par rate, we'll use the example over here with the good credit. The closest par rate would be 7% right here, like 7 1/8, 7%, because we're the closest at 0. And so you can't really get a par rate over here. Maybe that would be it, 8 1/8. And so, but this would be considered a par, like the par rate, if you will. Closest is $314. And so, and then if you're getting a lender credit, which we call premium pricing, it's basically where a buyer doesn't have a lot of assets for closing, let's say, and so they'll take a higher rate. And then what we'll do is we'll give them a credit back at closing to help with reduce the closing costs. And so haven't done these anytime lately, but it's like, I locked in at 4 1/4. I took the higher rate to keep my costs to close low. So the lender would offer a credit. It's called premium pricing. And then, of course, what we'll talk about in a second, paying points. And so paying discount points. Locking your rate, paying discount points is when a buyer pays extra money to buy down the rate. And of course, the cost is set by the market and can change. So here I locked in at 3.75. I paid a point because I wanted to secure a lower rate since we're going to have this loan for 30 years, for an example. And we'll look at that here in just 2 seconds. Is any questions on this one? Angela, did you say something? I'm sorry.
No, I just said I think that's a great chart and visual. So I've never seen that put side by side like that. I like it.
Go up here? Or
no, then I liked the one with the seesaws and the rates.
Okay, cool. And so these need to be switched. These but good. And so that's how that works. So again, par rate, no cost. premium pricing, you're going to take a higher rate, and the lenders. So for here, I'll just show you. So premium pricing would be basically like this. So you have 7% over here, which is almost at par. So let's say a buyer needs, an extra $1,000. Again, this doesn't happen very often, but you have first-time home buyers and things like that, and they needed an extra $1,000 to close. So what they'll do is, instead of 7%, they'll maybe take 7.625. This gives them a premium pricing. So then the lender will give this credit back, this 1272, and it'll apply it to reduce the closing costs. That's basically what premium pricing is. And so, but most of your buyers have lots of assets. Okay. Okay, so buying down the rate using discount points. And so how a typical rate buy down works, again, kind of broken record, but it's all based on risk. And then again, doing a break-even analysis of whether it's worth buying down the rate. We do a lot of this for first-time home buyers coming from the builder world. It's one of those things where does it make sense to throw more money at something to buy it down based on how much you're saving a month in principal and interest, and how long you're going to be in the home as well. So, for example, I look at break evens. So let's say, for an example, we're going to use that the rate sheet here in just a second. So let's say, for an example, we're going from the 7% to 6.5%. The cost is going to be $1,805, and we get that by trying to see that for a second. Let's see if I can get. I'm going to try to see if I can do this. I didn't have this on multiple screens, so I was going to try to. I don't know if you guys can see that. Let's see if I can make it smaller. Okay. So can y'all see that? Okay. So if we're going, so this is the closest to par with 7%. So we take, and this right here to 6.5. So let's say we started at 7. Do we want to buy down the rate to 6.5? So we're going to take the difference between, it's going to cost, for 7.5, this is going to cost $314. So if we want to go to 6.5, we're going to take the cost for 6.5 and we're going to subtract it by 314. And so that gives us this 1804. So then what we do is we take it, how much is it going to say, how much is it going to be worth it to the buyer? It's kind of what I come down to. A lot of times on the loan amounts, it's all dependent on the loan amount. You got larger loan amounts, of course, your principal interest payment could be big differences. And so the 7%, your principal and interest right here is $1,597. Shoot, sorry. And then your 6.5 principal and interest is $1,517. Okay. And then scrolling back. So it's an $80 difference a month in savings for this buyer to reduce their rate. It's pretty good. It just depends, again, on the loan amount and everything else. And so, so you take $80 a month divided into 1804, it gives you 22.56 months. And then you divide it by 12 months, and that's your break even of 1.88. So most buyers are going to stay in their home for 2 years at least. And so for this buyer to buy down the rate, if they have the assets and everything else, it's a good deal for them to do that. And then on the flip side, a lot of times we have buyers where this is going to be their dream home. They're not moving. They're on a fixed income. They're on pension, Social Security, things like that. And they want to have a certain payment each month so they can budget. Buying down the rate is very, it's a big benefit to them as well. So they don't have to worry about it. Any questions on that one? Okay, cool. Okay. So the last part we're gonna do real quick is the 3-2-1 buy down program. I know, again, we've been talking about it a lot, but it's different from a straight buy down because we're using the seller's credit again, and we're basically subsidizing the interest. And it's all based on the principal and interest difference, if you will. So the advantages for a buyer allows them to get into get into a home with a lower interest rate for over the first 3 years with an upfront credit, most of the time done by the seller. And then for sellers, it allows them to not reduce their sales price. And it just basically offers a credit at closing. Y'all don't have to do anything different on the contracts. It just says, seller credit, seller's offering X amount of credit. But also too, I should put in there another bullet where it's like, it's great for real estate agents because y'all get, to keep your higher commission instead of taking, $50,000 to $100,000 slash on the sales price. So, so an example, this is kind of what we've been talking about. Sales price of $800,000, get a loan amount of $640. Buyer putting down 20%, and then your start rate is at 6.5. And so we did this on the buyer that we closed in December. He set an initial start rate of 7%, and he got into the home at 4%. So, and then he'll probably come back in a year and a half, and we'll just refinance him. And so, and all that credit, and I'll show you in a second, doesn't get lost. So, y'all have seen these probably before. So, and stop me if you guys have questions or anything like that. But again, the initial rate, the start rate, the note rate, the qualifying rate, it's all basically the same. And so we have to qualify the buyer at the start rate. You can't qualify them at 3.5 because, and then as a race, then we'll run into a 2008 issue where people refinance or the arms adjust and they can't afford them. So, so for this, the start rate's at 6.5 here, and then on a 3-2-1 buy down, 3-2-1, the buyer will get into the home at 3.5%, and they'll be there for they'll have that rate for 12 months. Then on year 2, it goes to 4.5%, year 3, 5.5%, and then on year 4, 6.5%. What we're looking at in regards to the market and things like that is where, probably now rates will start to come down at the end of this year, beginning of 2024. So if you have buyers, of course, that want to get into a home, but they don't want to pay a high rate or anything like that, this is just a great tool. Or if you have a listing out there that's been on the market for quite a long time, the buyer's thinking about reducing the sales price, this is a great other option to offer, because a lot of times, for this 3-2-1 buy down on an $800,000 property, the seller would only, the seller credit's 28,000 and change. It's a lot better than, 50 grand or whatever, how much they would reduce the home by. And again, reducing a home at this high of price by like 50 grand, if a buyer does a loan, 50 grand amortized over 30 years is not a massive difference in regards to reducing the principal and interest payment. And so if you have a cash buyer, it's great, but our seller credit is far more favorable towards a buyer financing a home instead of reducing the sales price. So, next slide. Okay, so then and kind of working this through this as well. So what we're doing is we're comparing the rates. We're comparing from 6.5 to 3.5. So year 1, this blue right here, this buyer is saving $1,171 a month. And then year 2, they're saving $802 a month, again, compared to 6.5. And then again, year 3, $411. So let's say, for an example, the buyer decides to, rates come down, they're at 5.5 on a 30-year, they're at 5% on a 30-year. At the end of this year, beginning of next year, it's like, hey, you know what? I want to refinance. So I'm locked in on a 30-year at a great rate. What happens is all this green on year 3 or year 4 doesn't get thrown out the window. So basically, it stays. Think of it as almost like an escrow. And so only lenders who can service their own loans can provide this product. And so what happens is they refinance, refinances. I know it's not necessarily in y'all's wheelhouse because y'all do purchases, but in the same point, it's a selling point to the buyer, because they normally you refinance, all your closing costs you get refinanced, and you throw them into the loan. A lot of people do, or you can pay them straight out. But for this point, all that credit that's not being used, they can take down. They can, let's say the rate's at 5.5% at the end of this year. When they refinance, all that credit that's still left, they can buy that rate down, do a straight buy down on it as well. So it's a great tool. If I was buying a home right now, I swear to you, I'd do a 3-2-1. Anyhow, here's the 2-1, 4.5. Starts at 4.5. If your buyer's like, seller's like, hey, you know what? I don't want to spend a whole lot of money on her credit. We can still get the buyer in at, around 4.5%. And the seller would only have to, have a credit of around 14,000 and change. And then we also have a 2-1, or I'm sorry, a 1 year where basically it's just reduced by 1%. And so, oops, that's all off. And that's basically how the 3-2-1 works. You want me to go up in any screens or anything? Any questions on this?
How often are you seeing these happen? And you said there's one. I mean, are you hearing from like your peers in the industry that they are, people are really taking advantage of these?
Yes. So actually, we were in Fort Worth on Tuesday for their Coffee and Connect. And so, by the way, we have a new loan officer in Fort Worth. Woo-hoo. So just came on board, Ashton Burke. He's awesome. And so Devin over there, Angela, Devin and Alberto, they've done 2. They said last year but it was only a 2-1 buy down. And so the lender didn't offer a 3-2-1. So I had to be like, hey, we offer 3-2-1. So, but they did 2 deals in December, she said, on a 2-1 buy down. So it's one of the things where I know I'd be more than happy to talk to any buyers about it, and I can send you guys to the buyer, this these screenshots and everything. We have a Lakewood buyer. That's a barndominium, and so he did a 2-1. We didn't close, he didn't have any buyers, but it's a great tool because you got to think about it too. If a seller's been sitting there forever trying to list the home and trying to sell it, it's just a great option for them. Like, hey, Mr. Smith, you're trying to sell your home. You're thinking about reducing the price by 50 grand. Hey, we could probably, possibly get a buyer in here at, 28 grand or something like that. So, and you can advertise it on MLS, seller, offering your seller credit, things like that for a buy down. I mean, it's just a great tool. And again, at the end of this year and beginning of next year, based on supply and everything else, you're gonna have more competition flowing into the market because of buyers are like, oh, now rates are kind of getting a little bit better. So sellers are gonna push their prices up. And so I just say now, if you've got a buyer that's interested or loves a home, it's a great option to talk to the agent about. So.
Hey, John.
Yeah.
Do you think that seeing a big seller credit for a buy down like this affects appraiser's opinion at all?
Not really. I think depending on I don't know. To be really honest with you, I do not. I've seen them where It depends on how the seller, so on a big credit like this of 28 grand, if you have smaller deals where, well, okay, I'll just use an example. If you have a $20,000 sales price and the seller's offering a seller credit, and the seller and the credit for the buyer is like 6 grand. I'm not saying we're do this, but they can increase their sales price to cover the cost of the credit. So it's not necessarily, and that happens a lot. So as long as a home appraises, I don't think appraisers look at that necessarily. Now, if you're gonna have an $800,000 sales price, seller credit, I wouldn't put in there exactly what the seller credit is. I mean, you just say seller's offering a credit, at least to get the conversation going. For a buy down. I think as long as the seller doesn't increase their sales price, like over inflates it to cover the program cost, I think you're fine. So that's the only thing that I could see, but no, I mean, because for the most part, if you're advertising it, and there's comps, it's fine. They can't look at a credit and be like, oh, it's like, oh, well, especially if it's been sitting there. I haven't ran into that issue, to be honest with you. So, yeah.
Okay.
Yeah, I think as long as you don't overinflate the purchase price to cover for it, like over, you're fine.
Okay, thanks.
Hmm? Kind of ran through all that pretty quick. Last CE class, Doreen had to stop me. I said, "No, what's going on?" It was over an hour. I left her like 5 minutes. So that's basically, I think that's it really. So is there anything I should go back on? Does anybody have any, is there a chat? Okay, let's see. Copies of presentation. Yeah, absolutely. I think, yes, Joao. Everybody is. Cool. We have a lot of folks on this call. Thank y'all for
What's
spending
your timing now on getting something from the time you receive an executed contract and you get a buyer with an executed contract? What's your timing on getting something closed?
very fast. I mean, we can close deals. I try to get, if you got somebody, I try to get everybody fully approved if they're looking for a home. And so as soon as they can get a contract, we can lock the rate, and all we have to do is wait on the appraisal. Perfect world, that's the perfect world. But we can close loans in 3 weeks or less. It depends a lot of times on the buyer. If the buyer's performing and we can get it in, if you've got a close date, we'll do everything. We're very robust. We're very agile. Again, we're like a boutique lender. So it doesn't go through a conveyor belt like some of the larger, entities, if you will. I've got direct lines of communication to all my senior management. So if you need something done in like 2.5 weeks, we'll get it done. So.
Okay, thanks.
Yeah, absolutely. But if you got buyers that are, I'm trying to get, we've got our pipelines kind of starting to fill up, which is great. Get applications, now that we're through the holidays and we're, kind of on our way, if you will, rates are kind of behaving. We're seeing more interest, especially buyers coming in, trying to, looking for homes to purchase in May, summertime timeframe. So if I can get these buyers, pre-approved so they can start looking for a home, but then also start getting them into processing, getting them conditionally approved, and basically just ready to rock as soon as you guys find a contract or find a home to write a contract on. So that's my overall goal, to make it very, very quick. So.
Okay, thank you.
Yeah.
John, in addition to conventional loans, do you do VA, FHA, construction loans? What all do you offer?
We do all the loans. I've got 33 pages of wholesale lenders that I can broker deals out with, if need be. So if you have a certain scenario, I got a land and ranch deal, like not we didn't work out. It's a very unique property, but I reached out to some of our wholesale lenders, and we have wholesale lenders across the country that we can tap into. But yes, we do VA, FHA, conventional, USDA. What am I missing? Conforming, all that good stuff, jumbo.
Okay.
So, yeah. Yeah.
And what is conforming now? I know it went back up, way up. Is it the sevens now or something?
Yeah, so here in Texas, it's 726,200. So that's the new conforming loan limit. Last year was 648,200. So it has jumped big time, based on all the home prices have gone up so much. So, I mean, anything over 726,200, it's going to be in the jumbo world. And remember, jumbo world, the ratio's got to be a little bit lower. Buyers are going to have to request tax returns. You're going to have to have more assets in the bank. So it's a great loan. It's a great product. It's just more, it's a little more genuine, if you will. So
And there's not didn't it used to be jumbos were at a higher rate as a general rule, and now they're pretty on par with
They're pretty on
conforming?
par. It just depends a lot on
They're
the
lower.
investor and the risk. Yeah, they used to be, they're actually lower. So a lot of times we'd be like, people would be like, well, I want the lower rate, but I was like, well, your loan amount's going to be more. So I love doing jumbos, but also too, if the ratios are high, I always try to get them to, if they got the assets, hey, let's put a little bit more money down. Maybe we can get to the conforming loan limit. But because those jumbos aren't sold to Fannie or Freddie, they're normally sold to like US Bank, Chase, larger financial entities, if you will. And so that will service those loans. And so, yeah.
Okay, interesting.
But yeah, it's a, but and I've got some questions regarding like, the ARMs, just the pricing on those, because secondary market, they hedge all this stuff, and they got to make sure that the pricing is going to be correct. So the pricing on ARMs right now are just not that great. So that's why you're seeing the rates basically comparable to the 30-year. I think yesterday I sent it out. And also too, just kind of tidbit, I'm going to start sending rates out at least 3 times a week. I'm trying to do Monday, Wednesday, Friday for everybody. Get a lot of feedback on that as well to try to give you guys some ammo, if you will, and with no discount points. So these are national averages based on an index, so a range of rates based off of lenders at no cost. So yeah, so like the 5-year I sent out yesterday was at 5.95, or a 5-year ARM at 5.95, and the 30-year was at 6.04. So they're basically very comparable. So if you can get basically the same rate on a 30-year as you would on a 5-year ARM, totally do the 30-year. It just makes sense. So ARMs will come back once everything gets under control, if you will.
Yeah, great. And guys, if you guys aren't watching the reports that John's sending every Friday, they're really good. It's just really quick information. It's like 2 minutes, and it's a good way just to have that information. So when people are asking you, so I've really thought there's a lot of value in that. So thanks for doing that, John.
Great, thank you. And I appreciate that, Angela. If you guys have anything that you want me to put on there, let me know. I'm a feedback machine, so just shoot me an email, text, call me. Hey, you want to do this? You want to see this, or whatever? I'll be more than happy to oblige. So, excuse me.
John, I have a quick question. How do you guys calculate the limit of how much a seller can give credit-wise? I know that varies loan to loan.
No, so okay, kind of a rule of thumb. Let me see if I'll just draw it out. But so if a buyer is putting down, it all depends on the down payment and so or percentage of down payment. So if a buyer is putting down 10%, I gotta look at this. 10%, and they can only offer 3% seller concession. And then no, I take that back. My apologies. Now you got me stumped. So put it this way, if they put down 20%, they can offer 6% seller concessions if they put down over 25%, they can offer 9% seller concessions. And then let me here. Yeah, so here, I'm gonna put this right here. You see it? Is this what, so this is kind of, this is for conventional, and then FHA and USDA and VA. Sorry, I kind of had a moment of blindness for a second. So this is for seller concessions. So seller credit, it's kind of seller concessions is seller credit. And so if you want to take a snapshot of this, I can send this out.
John,
But like,
we
I
can't
don't think
see
that's the
your
right
screen.
slide.
Yeah, we can't see what you're showing us.
oh, you can't? Oh, I'm so
No.
sorry. Okay,
Yeah, we're still looking at the 3-2-1.
I'm so sorry. I'm trying to get it embedded in y'all's mind. No, I'm just kidding. Can y'all see this? Is that,
No, it's still your old screen. It's the 3, 2, 1 buy down.
all right, hold on a second. I'm so sorry. Let me do, oh, here it is. Okay. Sorry, y'all. All right. Okay, can y'all see that one?
Yes.
Thank
Okay, cool.
you.
I'm so sorry. Yeah. So so this is so this is the deal. Sorry, I kind of drew a blank for a second. So if you're putting less than 10% or less, or 10%, yeah, less than 10%, then you're 3%, you're maxed out. 10 to 25% down, you're maxed, that's 6, and then 25. So if you have a buyer that's like wants to put down 25 or 30% on a home, you can offer this up to 9% seller concessions. So I mean, I haven't seen too many of those. I mean, that would cover pretty much everything for the most part. And then FHA is stuck at 6%, USDA is stuck at 6% of the loan amount. And then VA is 4%.
Thank you.
Absolutely. And so, anything else? Any crazy questions? Any questions with buyers? Any sellers? I'm here to help. And so, I mean, just kind of wrapping up, but you know, I've had a lot of calls and texts over the past couple of weekends, and just in general, if you got, you know, everything, I've had questions, everything from inspections to appraisals, you know, to funky emails that, you know, just leverage me, even if it's a deal that I, you know, I'm not going to do or anything like that. You just have a question, just use me as a resource. So I'm here to help. And if you can't get me by phone, just text me and I'll call you back or text you back. So.
Thank you.
Yeah, thanks so much, John.
Thank you.
Thank you, John.
Got it.
Thank
you,
John.
Thank you,
Y'all
John.
are awesome.
Very
Y'all are
helpful.
awesome. Okay. Have a great
Bye.
Thanks, buddy.
Thanks.
Okay,
so much.
thank y'all. Bye.
Bye.